Hi class, this video is going to run through chapter 21 content, which is all about variance reports and how we use variance reports as an important tool to evaluate financial performance. If we think about variance reports are intrinsically linked to budgeting. So we really need to, before we move into variance reports, really understand this budgeting process and the role that variance reports play in it. Also to remember, variance reports will be really crucial in future chapters when we evaluate financial performance. So what is the budgeting process and how do variance reports fit in? Budgeting consists of 5 steps. We prepare a budget. We make our predictions of what is going to happen in our financial reports because we have budget cash flows, budget income statements, and budget balance sheets. That is a prediction, and we do that in advance. After that time has passed, we actually record the actual results. So we might make a budget for August 2020 at the start of the month, and at the end of August, we work out what our actual results are. This is where variance reports come in. Variance reports are when we look at the difference between our actual results and budgets and use this to plan, control, and make better decisions. We do this by interpreting the variances. What has happened to this variance? Is it a big variance or a small variance? Is it a favourable or unfavourable variance? How have they linked together? And what can we do to ensure we have better results, improved results in future periods? And this is what we're talking about when we say management decision making. It is a continuous process where, because after those decisions, we then make a new budget, which hopefully will then show what happens to our actual results. And this will be a continuous process to allow us to become a better, more profitable company. And as we mentioned, variance reports are a vital part of budgeting as they involve the comparison of actual results against the budget estimates. This process is achieved through the preparation of budget variance reports. And an important thing to remember, in 2020, you will not be required to prepare them, but you will be required to analyse them. And when we look at these differences, the comparison between actual results and budget results, we will either have favourable variances or unfavourable variances. A favourable variance, and you can see I've deliberately put the F there because you'll often see it just as F or U for unfavourable, is when the actual result is better than what was predicted in the budget. We've got a favourable variance because what actually has happened is better than what we predicted. This then means an unfavourable variance, U, is when the actual result is worse than predicted by the budget. But the question is, how do we determine what is favourable or unfavourable? And the answer is, unfortunately, we need to think. It's not as easy as increases being favourable, decreases being unfavourable. We need to think about what item in our reports are we actually looking at. So let's have a look at favourable variances. If sales for a period are predicted to be 10,000 and the actual result is 12,000, this is described as a favourable variance. This is a better actual outcome than what we predicted. We thought we would get $10,000 of sales and we actually got 12. Clearly this is favourable. However, if wages were budgeted to be $4,000 and the actual wages were $3,500, this is also described as a favourable variance, this time of $500. So you can see you've got to think, because for the first one, revenue, we want this to be a big number. We want this number to be high. So it's favourable if our number in the actual results is higher. But expenses, we want them to be controlled and be lower than normal. So if getting an actual wage expense lower than budget is a favourable variance, because both of these will impact our profit positively. So in summary, when determining variances, don't just consider whether the amount was higher or lower than the budgeted amount. You must also consider the nature of it. If we're looking at a cash flow statement, anything that increases our cash flow unexpectedly is going to be a favourable variance. An unfavourable will be if it results in a bigger cash outflow. So the key question to answer is, would the business owner be happy with the variance? If yes, it is favourable. So conversely, if we think about unfavourable variances, we can starts to become a bit easier. So if sales for a period were predicted to be 10,000, again, same budget, but the actual result was 9,000, then this is unfavourable because the business owner is not going to be happy with a prediction of 10, but actually getting 9. Similarly, if the wages were budgeted to be 4,000 and the actual wages were 4,600, this is an unfavourable variance because the business owner, again, would be concerned about that difference. It doesn't mean that it wasn't a good decision to make the wages 4,600. It could have been linked to higher sales and they needed to put more people on. But when we are just looking at a variance report, the first bit we do is it unfavourable or favourable? So once again, the nature of the budgeted item determines whether the higher or lower amount is favourable or unfavourable. Think about the business owner, whether they're happy or not. So let's now look at a budget variance report. The preparation of variance reports is based on just what we did. A simple comparison of budget predictions with actual results achieved. Here is a sample variance report for cash flow. Have a look at it, pause the video, and try and work out if you can work this out. Here we have a cash flow variance report. A simple one, there is only 4 inflows and outflows, operating and financing, and you can see we have a budget and actual difference. If we go through this, sales were budgeted to be $90,000. The actual result to 95. So the simple variance is 5,000. And then we do our thinking and realize it's favourable. What do you notice? We don't say whether the 5,000 was plus or minus, we just say the absolute difference. Payment to suppliers, $45,000 budgeted. We actually paid 48. This is a variance of 3. But this one is unfavourable because the business owner, this is going to reduce our amount of cash. It's a bigger outflow than what we thought. The loan is an unusual one. We budgeted that we would get an inflow of $20,000 of cash. We actually only got 15. So this is a variance of 5. And this is unfavourable. And this might feel a bit weird because a loan's liabilities, surely we don't want them to go up, but we're talking about cash here. We thought we'd get $20,000 of cash coming in. We only got 15. This is an unfavourable variance. Same thing with drawings. $14,000 expected of drawings. $18,000 outflow actually happened. So this is a $4,000 unfavourable variance. And this is the concept that you're going to be doing. You might not be preparing them in 2020, but you will be analysing them. So let's look at what one look like you might be given. These are some answers to some textbook questions, and you notice that they've also given the percentages. And they're quite more complicated when we get to actual questions. Here we have 2 different businesses, Broadway Formalwear, and this is a cash flow statement variance report. So we're going through all of the activities from operating to investing to financing, and thinking about what has happened that has been difference between our budget and our actual, and then thinking through the favourable or unfavourable aspect. Bigger aspect, another aspect here, we've been given the percentage, which makes us able to do some analysis. So I can look at this and do some quick analysis. In the operating, I've had a favourable month, favourable quarter. I thought I'd have 17,143 cash inflows, net cash inflows. and I had 20,202. 3,059 of a favourable variance, which is 17.8%. What drove this? Many things, largely more sales and more collections from accounts receivable. But because of this, it's been partially offset because I paid more to my suppliers. And this is how we could start to analyze it. And we could do something really similar for Selm's disposal store, which is an income statement variance report. We budgeted $2,260 of net profit, and we made a loss of $1,060, a massive 146% unfavorable variance. We would need to do a lot of analysis to work this out, but you can see there are many unfavorable aspects in my variance. Almost all of my revenues have been less than what I expected. And also many of my expenses were larger than I expected. So lots of reasons why. Even though overall my total expenses were favorable. So I had less expenses than what I thought, but this has been massively overcompensated by gross profit being massively unfavorable. And this is how we could start to do some analysis. I recommend you pause and do some more analysis yourself. And this is where we get to the end, interpreting. When analyzing, trying to make links between the various items. Don't just restate what has happened. Analyze, make links, interpret, try and work out and be that detective to work out what's happened. Some typical links might be, for example, an unfavorable variance in advertising might result in a favorable variance in sales. If I pay more money in advertising than budget, this is an unfavorable expense, but this might have been happened because I am seeing an increase in sales. A favorable variance in wages, I've paid less wages than what I thought, might actually result in a favorable outcome in net profit, or it could be linked to my sales being down and I had to cut down staff. So try and work out links and be that detective. Also, try and find links between variance reports across the different reports. How does a variance in an expense, for example, impact our cash flow and balance sheet? And now it's time to start to become that detective and to build on your journey of becoming an expert at evaluating financial performance. And variance reports and their important aspect in the budgeting process is a great place to start.